So hi everyone, thanks for joining. So this is Finance Meets Real Estate. So we have a great guest here today, Ryan Daigle, right? Daigle. So he's a former tech executive and current real estate syndicator, and he's going to speak about a very interesting topic in real estate education, I would say, our real estate profit, sort of like profit metrics and finance, you can say real estate finance. So this is internal rate of return. So as some of you know, so this is, probably among the more comprehensive metrics for gauging profitability of a project within a certain time horizon, but it does have a lot of deficiencies as well. So I'm very curious to hear about that and like how it's used specifically in the real estate industry. So with that, I'm going to pass it on to Ryan, and I look forward to hearing from what he has to say. Thank you.
All right, I appreciate it, Stefan. So IRR is not your friend. That is the title here. What I want you to get out of this talk is a deeper, greater understanding of how to properly evaluate the investment projections, returns, the risk profile of multifamily investments, and to stop worshiping at the altar of the one holy number, which in our industry seems to be IRR, which is the internal rate of return. I'm not here to tell you that like mathematically the number is flawed or that the way the number is constructed is flawed. That's not my premise at all. My premise is that we, as syndicators, which is kind of the role that I serve, we do a very, very poor job of really spending time educating our investors on what they should be evaluating, how they should be evaluating multifamily deals. And instead, a lot of times what we do is we roll out an IRR, we put that on the front, we tell people to focus on that. And it's human psychology to want to put a lot of attention into one number. We like simplicity, right? We like things to be boiled down to be very simple. So IRR, an indication of a return, that's the thing that our eyes tend to gravitate towards. It's human nature. But I want us to become more sophisticated investors. And so I'm going to try to show you how to do that here today. So let me ask you, let me lead off with a question, which is, how many times have you seen this? Doesn't it seem like every single multifamily syndication deal is going to trot out 15% IRR plus or minus, a very small range? Every single one of them. I went online and looked at some that publicize their deals. We've got a really nice property here in Fort Lauderdale, 15% IRR. Columbia, Maryland, 15% IRR. Austin, Texas, 15% IRR. Besides the fact that apparently if you have a pool, that means you get 15% IRR, there doesn't seem to be any similarity between these properties, right? They're all very, very nice, right? So they're obviously A class or above type properties, but they're in completely different parts of the US. They're in completely different markets. Who knows what the submarkets look like, right? Are you going to tell me that all these investments basically have the same return profile? That seems to be a bit specious. And just to make sure that, I'm not picking on any one provider, this happens everywhere. This is another one. I don't have the location of this specific one, but two completely different properties showing exact same return metrics. Now, what does this tell you when you look across the multifamily industry and you see pretty much every investment showing very, very similar returns? Is it that A, all these properties have the same risk return profile, or B, that IRR is a completely synthetic number that is created on top of hundreds of assumptions made by syndicators, and they all know they have to show a certain number in order to have a marketable property to you as investors? Okay. I am much more in the camp that IRR is it's too easily manipulated. And what we need to realize is that all these projections that syndicators put in front of you, they turn to crap on day one of ownership. You spend all this time up front putting together marketing materials. You've got your fancy spreadsheets. You've got your analytics. You've done your research, and all that's important, right? Plans are worthless, but planning is everything. That plan on day one of ownership, that's in the past. Everything that you made your investment decision on or based on, on day one of ownership is in the rearview mirror. Now you're dealing with a whole new reality, a whole new set of circumstances. Okay. So I'm just trying to convince you that putting so much weight on IRR and any other type of projected return is a flawed approach. It's a very lossy way of evaluating a multifamily syndication and multifamily investment in general, whether it's a syndication structure or a JV or anything else. You really need to be able to look one level deeper. So who knows what this graph is? And keep in mind, I'm coming from a software development background. Does anybody know what this is called? Obviously, it's labeled, so you get some sense of what it's trying to convey. This is, in software development, this is called the cone of uncertainty. It's basically a graph of how the relationship between time and uncertainty. And it basically just conveys, it's not just about software projects, it's applicable to all sorts of different scenarios, but it basically shows that in the very beginning of a project, you know the least amount, and thus your range of outcomes, the risk, the uncertainty is at its greatest point. Okay. And then as time progresses, you understand more about the problem you're solving, you understand what the end deliverable needs to be, and your range of outcomes gets narrower and narrower until at the final day of a project or delivery, or in our case, an investment, when we finally exit that position, we sell that multifamily asset, that's when we know everything there is to know about the project. Okay. So if we think of this axis, the y-axis, as risk, which is correlated to returns, projected returns, you've got a huge variance in the early stages of your project. When you have when a syndicator has a property under contract, when they're going through due diligence, it's a very early stage of understanding what this property is about, what the potential is. And so you may fire up your spreadsheet, you may make your best effort guesses and estimates and putting in everything you know. You may be a very experienced operator. So you put in all of these very valid assumptions into your spreadsheet, but you cannot hope to have any sort of dialed in knowledge or certainty around what the final outcome in terms of investment returns for that property is going to be over 3, 5, 10 years. It's just impossible. So your range of outcomes from your marketed IRR is probably plus or minus 10% at the least. In the good times, if you bought something in 2014, you were off by 30 or 40% to the upside, right? So your investors were happier and you looked more competent because it was just an amazing environment. But don't you think if you knew you were going to get a 30 or 40% IRR over 2 years in 2014, you would have marketed that to your investors? You would have. You just didn't know, right? So a lot of things have been off way to the upside recently, but in different stages of the market, you can bet that there's also downside risk here. The point is, at the beginning, you just don't understand. So what do you think this line represents? It's not to scale on the time axis, but that is your day of close. Okay. You've done your due diligence. You've gone through the acquisitions process. You have tried your best to evaluate the property, what the rent potential is, what your CapEx and renovation budget is. But guess what? On the day of close, you've narrowed the gap just a little bit. You still have such a massive amount of time ahead of you as far as the ownership of your property that your cone of uncertainty has not really narrowed that much from the day you put it under contract. Okay. And again, you made an investment decision based on material that was constructed and created during the period of greatest uncertainty. So how reliable do you really think those numbers are? That's really kind of the point I'm trying to make here, is that these projections just fundamentally and by definition are not that reliable. So should you just throw up your hands and say, oh, well, I guess I'll just choose the operator that I happen to like the most, or that my dad knows, or a buddy of mine knows, and just go with that? No, there are still ways to properly evaluate an investment for yourself, for your own risk profile and for your own return expectations. But I want you to walk away with a greater level of sophistication as an investor and a whole litany of other things that are kind of one level below return projections, of which IRR is one. There's average annual return, even cash on cash. These are just projections that are built on piles and piles of assumptions. I think there are a fundamental set of properties and characteristics that are more useful to you as an investor. They may not spit out one number that you can put on your mantle and say, this is the best summary of this particular investment. But in total, they do give a much better sense of the characteristics and the risk reward profile of a particular investment. And I kind of think about these things across three different buckets. We've got the property characteristics, right? So the fundamental characteristics of the property itself, the physical characteristics. You have the business plan, so what the syndicator or operator intends to do with it. And then you also have the assumptions that go into the underwriting. So what I want to do today is walk through each of those buckets bit by bit. It's going to be a lot of volume of information I want to throw at you. So get your notebooks out, but I want you to walk away with just a better understanding of how to really critically look at syndications and multifamily investments. And it's the outcome of this will not be, this is what a perfect investment looks like, or this is what Ryan does on his own deals. A good outcome of this talk will be for you to have the tools to be able to evaluate these investments yourself and identify where the areas of greatest risk are in any one deal, where the areas of greatest leverage happen to be, and perhaps some inconsistencies in the story that your syndicator is telling you that you can go back and just have that discussion with them. Okay. So again, I don't claim to have all the answers. I just want us all to be thinking at a greater level of clarity and criticality than what I see most offering memorandums out there spewing. By the way, I have my chat window open. If you have questions throughout, feel free to drop them in there. If I'm at a good stopping point, I'll try to do my best. And if not, we'll collect them all at the end and Stefan will make sure that they get answered. So the first bucket I want to talk about are the immutable properties of the property itself, right? And I think about this group of characteristics as things that are going to define the ceiling of the opportunity, okay? They're unchangeable characteristics of the property. So by nature, they define the best possible, the most you could ever expect out of the particular asset. So let's go into each one individually and talk about what the boundaries are for each. So the first is the vintage of the property. Okay, each vintage has a certain set of concerns that you should be aware of as a passive investor, and you should hope to see them addressed in some way by your operator, or at least know to ask these questions of your operator. So, wonder why I look like this hard? Oh, hey, Lanya, I'm gonna put you, or Stefan's gonna mute you real quick. Here we go. You had some background noise. Sorry about that. If you have a question, feel free to drop it in. Just heard a little background noise there. So the vintage of the property. If it's a 1970s property, you things you're going to be dealing with are aluminum wiring, which is unsafe and needs to be remedied at a non-trivial amount of cost. The ceilings might be 8-foot ceilings, right? There's going to be some plumbing and structural limitations or maybe issues. Those are things, if you're looking at a property in the 1970s range, you're going to want to make sure are being accounted for. Bad stuff, bad assets, you shouldn't be investing in them. It's just, if you are investing in them, know that this is the kind of thing that needs to be accounted for. In your 80s to 90s vintage, you've got things like PEX plumbing, which is this plastic plumbing that has turned out to be very brittle and causes all sorts of problems. If you've got that stuff running throughout your walls, that could be a constant source of issue there for your property. Vinyl siding that's really cheap. You've got roofing that's coming up on end of life. HVACs are the same way. 2000 and 2010s, usually it's pretty good quality. I mean, quality does vary by asset class A, B, or C, but you're also coming up on your end of life for those 10 to 15 year type systems like HVAC, hot water heaters, and whatnot. So that's one bucket of things to be aware of. And where this manifests is mostly in your expenses, right? So I'll talk about it at the end to kind of button everything up. But in these buckets of characteristics of the property that I'm talking about, it's not that any one thing, it's that you want to see consistency in the immutable properties of the apartment complex and the business plan and the underwriting. You want to see a nice consistent line through all these things. And if there's something in the vintage that might be an issue, that it's addressed in the underwriting, it all needs to align and create a really cohesive story. Where you get into trouble, and where as an investor you can spot deals that maybe haven't been thought through well enough, is when you spot these inconsistencies. So as I go through this, I'm going to try to call out, again, not what's good or bad, but when this exists, this is something you need to consider. Okay, so if I'm buying a 1970s product, I might want to see that there's a line item in my CapEx for remediating the aluminum wiring. Or I might want to confirm that, are the rent projections post-renovation accurate if I've got 8-foot ceilings and every other property in my area has 9 and 10-foot ceilings, right? Those are things that are very hard, if not impossible to change. It might put a limit on your upside. So again, these are things that kind of limit the ceiling of the opportunity itself. Also part of this bucket are the unit mix. So how many bedroom and bathrooms are there for each unit? Are they small or big, right? You got the square foot. The floor plan itself, right? Garden, which is 1 story, versus townhome, which is 2 story. A lot of times townhomes are more desirable in a certain area. You might have greater rental upside with a townhome format because it feels more like a home. You've got some separation in living space versus garden. So, if I see a property that has a good mix of 1, 2, and 3 bedrooms and it's townhome style, those are all positives in my mind, because they indicate potentially there's a higher ceiling on this property than a similar vintage property down the street that's just all garden, all 2 bedroom. Even with some recent construction, you can even have garages that are attached garages in apartment complexes, which is something I never had when I was growing up. Apparently they're building it now, and I've seen it on some A and newer B class stuff around here in Raleigh, North Carolina. So again, these are all things that affect how high the property potential is. Also in this bucket are the amenities, kind of the in-unit amenities, and also the external. So is there built-in washer and dryer in the units? Is there a laundry facility on site, or is there nothing and people have to go off site to get their laundry done? Obviously, if you're aiming for the top 20%, 30% rent in your area, and you're asking them to go offsite for rent for wash and dryer, that's going to be a really hard sell. Same for in-unit dishwashers. Does the property have a pool, dog park, storage areas? Is there a trash service, or people need to carry their trash out to the dumpster? These types of amenities can also limit your upside or expand your upside compared to similar properties. The other immutable characteristics are where the property is. So the metro itself, the market, right? Is this a growing market? Is there good economic diversity in the city? What's the quality of jobs? Is it mostly a manufacturing area? Or is it filled with tech professional, white collar types that are earning a lot? Once you have a sense of the market potential, you can also drill into the submarket. So things like crime, what's the median income in that 1, 3, 5 mile radius? How close is it to various commercial and retail, shopping centers and groceries and Whole Foods and all that fun stuff? And is it in the path of progress? Is it close to other really good neighborhoods? Just a sense for what's happening at that micro level. So those are all the properties that really define what the highest use of and highest potential of your whatever apartment property you're looking at is. So it just paints that picture. So I'm going to pause here and look at some of the questions or some comments. So yeah, Gabriel, great point about asbestos and lead for older properties. I think in the 70s is kind of a good line of demarcation between when some of the asbestos and lead was used pretty heavily versus when it was outlawed. So that's definitely also something that you have to be aware of when you're going into a property. And again, a lot of times these properties have changed hands in this industry or in this market. They've changed hands 3 times in the last 10 years. So there's a pretty good chance that one of your previous owners has remediated these items. but you don't want to assume that, and you want to definitely make sure that your operator, whoever your sponsor is, can answer that question and is aware of that thing. Chris, you had a question about if the property is ground up and new, look at. I'm going to say I don't have experience with that, so I'm not going to act like I've got the answers. I haven't done new development, haven't invested in new development. I'm on usually the opposite end of the spectrum, which is, kind of that 1970s, like we were talking about, 1970s plus heavy value add repositioning type plays. So I just don't have any experience there. I don't want to lead you astray. Great. So the business plan. I think about this. So the unchangeable properties of the asset, it defines your upside. The business plan is how much of that upside the sponsor intends to capture, okay, and how they're going to go about doing that. And there are a few different things to think about here with the business plan. First of all, what is the tenant base that you're working with, at least on day one? And what does the sponsor believe that they're going to be able to do with that tenant base? Okay, so on day one, are they walking into a bunch of people that are on subsidized housing? Whether they're on subsidized housing or not, are you walking into something where you've got a lot of existing balances that are already built up, right? Some indication of a population that is not paying on time, is being very late. They're letting things build up. Maybe the property management has not been very good at collections. That could be opportunity, but it also could represent you're going to have a lot of work to do to change the habits of that tenant base, or to just reposition the asset itself so that better tenant place. And so if I see a business plan that acknowledges that, hey, on day one, greater, I'm going to be pretty skeptical of that claim. That's not the alignment that I'm looking for that I talked about earlier, right? I know that there is a lot more work that goes into repositioning than just letting leases expire and doing work. It takes a long time to kind of flesh that out. A lot of times you just can't change a tenant base in one fell swoop. Okay, so the effort and the time allowed for repositioning, especially when you're talking about not just the physical investment into the property, but also turning the tenant base, is something that I'm going to want to see alignment of with the business plan. Commensurate with that, you've got the renovation budget. What is the sponsor intending to do with a property? Okay, I kind of think about this in also 3 buckets. A lot of my thinking apparently is in 3 buckets, so I must be a pretty simple person. But kind of from my experience, if I see a CapEx budget and it's about $2.5K per unit, to me that's a light value add. That's basically a turn, right? When a tenant leaves and a new tenant comes in, sometimes you have to replace the carpets. Sometimes you got to do a new paint job. Maybe there's some things that are scuffed up. 2.5K doesn't get you very far. At the most, that's a very, very light value add business plan. In your medium business plan or value add, you've got, that's more of a budget around $5,000 per unit. And then super heavy value add, which is going in basically replacing or refreshing almost everything in that unit, is going to be 8,000 or above. And yes, this is all very market specific, but this is the general ratio and relationship between those 3 buckets. So, if I see that there is a business plan and it's calling for new appliances, cabinets, flooring, vanities, cabinet doors, it's calling for the whole 9 yards, but their budget is $5,000 per unit. I'm gonna want to poke at that with the sponsor and make sure that they're being realistic. Maybe it's a 200, 300 unit property. They've got existing property management that they've done this with already on existing property, so they know it can be done. It's in the same area. That their scale allows them a better cost basis than I could ever hope to achieve. That's absolutely possible, but it's something that you're going to want to really dig into and make sure that you understand. And of course, you can't forget, major budgeting for major systems, right? So these little light, medium, heavy value add buckets are kind of my rules of thumb around just the interiors themselves. And a lot of times, if you're doing a heavy value add on the interiors, it's usually not that the interiors are trash and outdated and the exteriors are perfect. So it tends, the exterior budget, additional budget tends to be pretty commensurate with what you're spending on the interiors as well. So Mark asks about, are these amounts unit count specific? There are definitely economies of scale when you get up into the higher units. I've seen some operators, that are in the 200-300 unit range. It seems like they can get done for 5,000 to 6,000 what I could get done for 7,000 to 8,000. So there are definitely efficiencies to be had, but they tend to be in the similar ballpark. It's not like they're half, right? They're maybe 20%, which is non-trivial. So it's a meaningful discount. So definitely something to think about. It is where it is in the country, right? If you're in the Midwest or rural area, maybe your cost of labor is a lot cheaper. Maybe you have access to supplies that are a lot cheaper. A lot of factors that go into that, but certainly size is one of them. Also in the business plan, and this is kind of has to do with underwriting as well, but it's I put it in this section for now, is to really look at your expense ratio. And if they're too low, maybe your operator is being a little optimistic, right? The easiest things and the things that have the biggest impact on your outcomes, or at least on your projections, are your top line income. And then the next is your expenses, right? So if you can chop off a couple thousand here and there on your expenses, and every single line item on your expense projections, you kind of shave to the lowest realistic range and not allow any buffer, then you might end up with an expense ratio that's pretty low. But to my earlier point about the renovation budget and the light, medium, heavy value add budgets on a per unit basis, this can vary by number of units and other factors. And what I have seen, and this is again based on my experience in my markets, if you have an operator that swears up and down that he's seen differently, then I think you should actually, you should definitely talk to them. It may very well that they just have a different approach, or have some different realities. But from what I've seen across quite a few different opportunities and my own operational experience, is that when you have a small multifamily, call it 20 or below, you can really get that expense ratio in the low 40s. I wouldn't recommend to underwrite at 40%, but on an average basis, you'll have some months where it's 30, 35%, some months where a pipe breaks and it's up to 45, 50%, but you can settle into the low 40s if you've got a small multifamily property, especially if it's in decent physical condition. Conversely, if you're 80, 100 units or above, and as you go up in the asset class itself, if you got B, A plus stuff, then your expense ratio can get down 40s and even high 30s. If you're in the middle though, and I have properties here right at 50, you're big enough to need some specialized love and care in the property and maybe some on-site representation and maintenance people, but you're not big enough to really support full-time payroll. So that's kind of a no man's land. So I kind of see the expense ratio as a bell curve. With super small, you can get pretty low. Super big, economies of scale, you can also get pretty low. But if you're in this in-between slot, if you got a 50 or 60 unit and your operator is showing you a 40% expense ratio, maybe they'll hit that, but that is certainly not leaving a lot of room for variance. And mostly the variance would be to the downside. So just something to keep in mind there. Another part of the business plan to be really conscious of are your reserves. Is your lender requiring reserves? Is your CapEx budget part of the raise? Or is the operator going to be feeding off of the cash flow? If they're not raising all of the CapEx budget, maybe plus a little bit, then that's coming from your cash flow. And if they're showing you that you're still returning cash flow in years 1 and 2, something's not right with that equation. Same goes for replacement reserves, various escrows that your lender require, and prepaid expenses like taxes and insurance. You definitely want to see those as part of the raise to know that you can execute on that without having to have your property cash flow. The think I've got two more here on the business plan itself. So property management, whether it's on-site or off, if it's on-site, it's going to cost you more. You can't just play, or those property management companies, they don't structure their fees in terms of just a flat percentage. They'll usually do 3 to 4% flat fee of collected rents, plus you're going to be paying for the payroll of the people that they're putting on site, even if it's on a part-time basis. And this kind of gets to the expense ratio, and is one of the key factors in that expense ratio being in the bell curve, in that middle area being higher, which is if you're 40 or less, you probably don't need an on-site representation. If you're 80 or more, you do need on-site representation, but you've got enough units that you can support full-time salary. If you're in the middle, it really depends on the rest of your plan, right? Is this a fully stabilized property? Then you may not need on-site representation, and it's just a leasing agent every once in a while that's going to show a unit, or a maintenance person that can come out on demand. If it's a pretty heavy value add, maybe you want some representation on the site. You're going to want a full-time maintenance person so your expenses can be handled in-house and you're not always vendoring out to other vendors. So how property management is handled and what kind of representation you have is a key part of that business plan. And you're going to want to make sure that it aligns with the work that they're intending to have happen on the property itself. And then it looks like I got an extraneous bullet point here, but the disposition itself, right? So who do the current operators think that they're going to sell to? There's, especially in this market, there's always a buyer, right? But it's good to have an exit plan and to kind of have a profile of who you're going to be selling to. A lot of times, if it's value add, you've increased the value of something. So your group went in and bought at a low price a value add business model. Do you know who's going to come in after you and buy what you think might be stabilized? Maybe that's going to have some impact on your business plan. And maybe you want to cut your business plan short and leave some meat on the bone for the next person to come in so that they can say, hey, I'm buying value add too, and get some of that upside, right? So you want to think about who you're going to sell to as you're buying the property, just because that has backwards effect into your business plan. So the last bucket here is basically the underwriting. These are the points of greatest leverage into the underwriting, and they really define.
Ryan, just for a moment, does everyone see the slides changing? Because on my end, I actually don't right now. It stopped at some point. You do?
Yeah, they're changing.
Okay, yeah, sure. Yeah, then I don't know. Maybe it's
good.
All right. Okay.
I'm gonna pause here. I want to make sure I'm catching some of the questions. Great. Okay. So explain how the expense ratio is calculated. I mean, at the very highest level, the expense ratio is your total operating expenses divided by your gross income. Okay. So if I've got collected rents in 1 year of $100,000 and I've got $48,000 in expenses for that year, that's a 48% expense ratio. So it's just a quick hand way to see how efficient the property is operating. And there are some rules of thumb that based on the asset class, the business model, the size, the scale, everything else, you can kind of get a sense for if an operator is being super optimistic about their projections, and does it align with what you know of the property. Rachel said, love to see a full sample business plan. If you have one to share, I actually do have one to share. If you circle back with me on my contact info on the last slide, be happy to send something out. And then Jan was saying this is the expense to gross rent income, right? Yes, that's exactly right. Okay. All right. So this is the last bucket, and this is where operators always feel the pull to tweak things a little bit here and there, be a little optimistic here and there, to squeak out that last little bit of IRR so that all you investors will be happy with them. It's human nature. We know investor expectations, and it's human nature to want to cater to them. So this is where in the underwriting and in the projections process, that if you understand the other parts that I've talked about, about the property and the business plan itself, this is where it all comes to fruition. And you can really tell if the operator is saying one thing in this part of the prospectus, but then you go and you look at their underwriting. Again, you look one level below their projections. You're going to see if they're being a little optimistic in some ways, or at least be able to identify when they might be making assumptions that you're not comfortable with. Doesn't mean they won't come true. Again, every operator in the past 5 years has probably outpaced their IRR by 10% to the upside. But again, it just goes to show that you really don't know what you're getting into until you're in there. So let's talk about where those greatest points of leverage are in the underwriting itself. So one thing to look out for is if you go to, and by the way, I would say the most important part of the investor packet and the underwriting to look at is your P&L, right? You want to see a year 1 through whatever stabilization is, call it year 5, call it year 3. You want to go to that P&L part of the offering memorandum and just get really comfortable with looking at a P&L, because that is the source of truth, right? All the inputs into underwriting result in some number, some line item existing on the P&L itself. And the P&L has pretty much everything outside of the capital expenditures, has pretty much everything about the operational nature of that property. So it might take some time, but don't be intimidated. I think this group is probably very comfortable with numbers and spreadsheets, so it shouldn't be an issue for you. But head very quickly to that slide in the OM as you're looking at things. And these are some of the things you're going to want to look for. First of all, the reposition timeframe. If you see that post-renovation rents are going to be $800 a month, and you go to the P&L and you see $800 a month in year 1 average rent, they're not, that operator is being super aggressive about how quickly they think they can implement their new rents. They can go through the physical rehab, they can reposition tenants. And again, year 1 having $800 rents means for the whole course of the first 12 months, you're charging $800 rent on average. So that means on day 1, things are already operating smoothly, which again, if there's misalignment with the business plan, it's a heavy value add or even light or medium, and yet they say this, they're being too aggressive on their reposition timeframe. Also, the rent growth itself, this is a pretty basic one. There are 2 types of rent growth, right? There's the kind that you are forcing because of your repositioning and your value add. But not all business plans have value add, right? There's some that are like, look, we're just buying a stabilized property. It's cash flowing. It's a great asset and a great location. And we're just going to ride out basically the rising tide of this market and banking on the ability to get 3% rent growth per year ad infinitum. That's been true for the last 10 years. I'm not going to say it's not true for the next 10 years, but those are 2 very different types of rent growth assumptions, right? One is the ownership group is physically doing something and is managing and improving a property to achieve a certain amount of rent growth. The other is I'm going to sit back and rely on this really strong, good market to keep rising. Both can be true. But it's up to you as an investor to understand what you are comfortable with, okay? Because those are 2 very different types of growth assumptions. One other thing to look at is the other income line of the P&L. It can both be, what you want to understand is how durable and sustainable are the items in the other income. Because not all income is created the same. Not all income will be valued the same by whoever the next buyer is. Okay, so if the sponsor is throwing every little knick-knack, dollar here, dollar there that they think they can extract out, that's not rent itself, it won't all be the same, right? Is it an on-site laundry unit or laundry room that they think they can get $1,000 a month from, but the units all have in-unit washer and dryers, right? And they're repositioning the tenant base. And so what were tenants that might not be able to afford their own in-unit washer and dryers are going to be repositioned out to tenants that are, but yet they're still assuming that other income is going to stay the same from this community-based laundry center. Are there cable and internet contracts that they're going to put there? Well, it looks good on the P&L. It doesn't increase your top line, but if that next buyer, you're making the assumption that what is like a temporal contract is going to be there forever. That income is not valued quite the same as rents, which are much more durable, right? They're not subject to the whims of business decisions and contracts running out and things like that, and other vendors that have a say in it. So just make sure that the operator is not throwing every possible thing into other income as a way to juice the top line. But in saying that, there are some very real opportunities to take what is currently an expense and change it into another income. I think you know that utility bill back and RUBS is a great example of that, right? So once you either update your infrastructure or update your leases to allow to bill back utilities, if it's on a master utility setup, you're probably not going to go back. And that is something that the next buyer can just continue running and there's no end in sight. So that's a durable source of other income. And you're taking a 10, 20, 30, $50,000 expense, turning into other income. That's $100K delta between your previous NOI and the new. So that's a pretty, that's a pretty solid return. So it's not that everything that goes into other income is suspect. It's just that you want to be really sure you understand what are the individual components of that other income. So top line growth between rent growth and other income. If you've got strong top line growth, if your rent growth is growing beyond what you projected, your business plan is going to look amazing. The next item down are kind of and speaks to what you're able to collect as far as rent are your vacancies. So are you accounting for increased vacancies that come with a heavy value add business plan, or the need to reposition all the tenants into higher quality tenants? That doesn't happen without breaking some eggs, right? You're going to have to non-renew people. You're going to have to go in and fix units up. That doesn't just happen magically, right? There's time that it takes to go in and do that. You got to put it on the market. You got to find a new renter. And so if a property has been operating at a 4% vacancy for the last 4 years, and they've got below market rents, and the plan of the new company is to come in, invest in the property, increase those rents, you're probably not going to still be at 4%. Certainly in year one, where you've had to go in and change a lot of things out, you're probably going to want to see 6, 8, 10% accounting for total vacancies. And then going on from there, if you are going to be managing and having rents that are closer to market rates and not very under market rates like the previous owner, you may also want to account for just a higher baseline in vacancies, right? So something closer to 6% rather than 4%, which was kind of the depressed rent baseline. So I have some kind of rules of thumb here around economic vacancies that I use matched to the asset class of the particular asset. So if it's A class, you can do 1%, economic vacancies, which are bad debt, loss to lease, delinquencies, things like that. B class is 3 or less, and for C class, I use 4%. And this is also during the times of COVID, which affect things. So I don't mind being a little more conservative here than in other times. Really big item is financing. And I think we all know about LTV, right? If something's at 80, 85% LTV, that's pretty highly leveraged. You could definitely juice your returns. You can show better IRR if you're using greater leverage, but that also increases the likelihood of you getting trouble if there is some downside in the market, in the property itself. Lots of things can go wrong. So how much buffer do you have to the downside? It may be that you are pretty risk tolerant. You love the property, the operators, have experience, and you don't mind being a little more highly leveraged. That's fine. That's your choice. You just need to be aware of it. There's also the alignment of how long the term of the loan is to your business model, right? So if you've got a business model that shows that you're going to come in, buy a stabilized property and let it run for 10 years and just rely on the rent growth in that area, but you have a 3 or 5 year term loan, there's a misalignment there, right? And vice versa, if you're doing value add, you tend to want to see alignment of the term to when you're going to be ready to capture the most value of the property. So in a value add, year 2 or year 3, you're probably fully stabilized. Maybe you want to let it sit for a year in season. and you want to have a year where you're not forced to sell. So you'd probably be looking at a 3 to 5 year term if you're doing a heavy value add or reposition play. The other part about your financing you want to take a look at is the prepayment penalty. If the business plan is for sure hold for 10 years, but yet you're paying a higher interest rate to have a lower prepayment penalty, then something's not right. You're paying for flexibility. Maybe you want that flexibility, but it's something that you need to be aware of, that there's a cost to it. I have an article on the different prepayment penalties on my site as well. It's a little esoteric of a concept or of a topic, but it's pretty important. And I see a lot of confusion around the different types of prepayment penalties and what it even means. So spend some time to kind of clear up that stuff. Oh man, the exit cap. This is one of the easiest ways to get 1 or 2 more percentage points out of your IRR. It is so tempting in every underwriting model. Like my finger just itches when I'm hovering over the exit cap assumption in my underwriting, because if I drop that exit cap by 1/4 of a point, I can get 1 more percent of IRR that I'm showing my investors. It's a very, very high leverage field in underwriting. So you really want to look at this. And I see a lot of properties that are like A-class properties being bought, and they're stabilized A-class stuff, new build, last 5 years, being bought at very, very low cap rates, 4.5%, some even lower now. And you go look at their exit assumptions, and it's like 3.5% cap rate exit assumption. Like, wow, like that is basically saying that if you bought that property all cash, you would be earning 3% on your money. Now, we live in weird times, right? There's negative interest rates on bonds. There's been cap rate compression for 10 years running in multifamily, at least 7 years running. So that could very well be reality in 1 to 5 years, that our cap rate's super low, and thus the value of our properties per NOI have increased a lot. Very, very rosy returns on. Have to think about is that a climate? Is that the economic climate that you are wanting to bank on for your investment? That in order for your investment to hit the returns that it's showing, you're going to need basically the best possible economic climate for that particular asset. So look really closely at the exit cap assumption. My rule of thumb is to take what, because cap rate, it's tricky, it's super tricky. And by the way, I do also have an article on cap rate on my website, so that's I can send these links out later if you want to, but it's a really in-depth topic. It's basically a measure of value of the property, but it's really only useful for stabilized properties. So for value add stuff, I like to look at my market and whatever the cap rates are for the particular asset class I'm investing in today, cap rates for today for a stabilized property, and I'll add maybe 50 basis points. So if stuff is selling at a 6 cap stabilized, I'll maybe assume that in 3 to 5 years, my exit cap is going to be 6.5%, right? It allows for, it's not super conservative, right? But it allows for the fact that, hey, we've been in a compressing cap rate environment for a long time. I could see that start to change. So it's allowing for some expansion of cap rate, which has the same effect of reducing the value of the property. So you'd be really surprised at how taking a projected cap rate from a projected exit cap from 6 to 5.5 could add percentage points on your IRR. It can really change the outcome of the deal. So be sure to look at that and make sure that you agree with what it implies about the assumptions. So the return stack is basically how you are paid, how you as the investor are paid. Things like return preferences, hurdles, they all affect how soon you get your money, and comes from right? So you get the first 9 or 10% return, but none of the upside. And then class B is like you get a 7% preferred return, and you get to participate in the upside along with a general partnership. I think that that's a fine way to structure deals. It means you can cater to two classes of investors, some that are more risk conscious and maybe want that first bit of the preferred return and are willing to give up the upside. And then others that maybe want the upside and believe in multifamily as the asset class. It's fine to offer that. But when you artificially limit the returns to some segment of your equity base, you make it easier to achieve the returns on the other. So this is a way to take a deal that maybe doesn't show that 15% IRR that every syndicator wants to show, and lets them offer two classes of shares, one of which where there's upside, you are able to show that 15% IRR. So it's a little bit of financial engineering, not in a sinister way. I think there are very valid reasons to do that, but just, it's something that you can be aware of, that exists with deals that may not have a lot of upside. This is one way to give at least more upside to a smaller segment of your investor equity stack. Similar thing with ownership structure. 70-30 tends to be pretty common. If it's 80-20, where 80% are going to investors, does that mean this deal is really thin? And in order for this operator to get enough investors, they have to take less of the pie? Not a bad thing. I'm not saying you should not invest in these, but you should also look at how is the general partnership incentivized. I mean, I'm an operator, so I am probably speaking my book here, and obviously I want to be able to put food on the table, but I want to know that when I invest in a deal, that the general partnership, the operators, have an incentive to keep managing that deal, that they are properly, they have a sustainable source of income from the deal itself, so that they're motivated to keep putting effort into it, right? It's a hard proposition to say, you've got to manage this deal for me, and you're not going to get paid until 5 years from now. I mean, there are many deals that work like that, but I like when my operator gets paid when I do from the cash flow. I've done deals where there is no pref, because I'm like, you want to be aligned with your investors, and there's no better way to do that. From the first dollar that comes out, we're splitting it 70-30, right? And the returns are still, there's enough returns there that all of us are getting fed, right? So making sure that everybody's incentivized in the right way. There's also something called preferred equity. This is different than a preferred return. And it's basically somebody who sits in the equity or the capital stack before you. So they get first access to the returns. They also get first access to the equity on disposition, or if something happens to the deal and it goes under, you've got debt, which is your first lien position. They're going to get everything that they are owed. They're going to get theirs back first. Preferred equity might be next in line, and then you, as just common equity, are last in line. So that affects your downside a little bit. So just something to be aware of, there. So I'm going to pause here and look at some questions. I know we're coming up on time, Stefan. So I had a few more slides, but I'm going to go ahead and stop, and we can do questions.
No worries, take your time.
So to kind of summarize, I think what I want you to walk away with is a greater understanding of how all the factors that go into the business of purchasing a multifamily property and running it and operating it and maximizing its potential, how they all align and should be consistent throughout, so that the story of this property is consistent from the upside of the property, what the business plan is of the property, and the underwriting assumptions that the operator has put in front of you as an investor. So for the ability for you to call out and identify where the points of leverage are, where the points of risk are in any deal, and any inconsistencies that exist, without even looking at the IRR or the return projections of your offering memorandum, you should be able to just take that slide, put it over somewhere else, and go through that business plan and be able to come to some sort of conclusion on your own about whether that investment is right for you, has the right risk reward profile. So I had a few examples here. I'm going to save it for, I can send these slides out, Stefan, but I want to make sure that we get to some of these questions. So thoughts on interest only, how many years of IO is okay? How much is a stretch? This is a good point. I think it was a bullet point on one of my slides. I've seen some really aggressive, so it tends to happen more in A-class stuff. I've seen deals really, high quality properties that are purchased at super, super low cap rates. The assumption of an exit cap is also very low, and their financing has like 5 years of IO. So obviously it's cash flowing pretty well over those 5 years, and it's assuming rent growth. But over 5 years, you're not paying down any principal. So it just speaks to how much buffer the operator plans to add to the bottom line as the property operates. If it's IO for 5 years, all that cash is being distributed out to investors. You're not building any safety net as the property grows. So definitely something to look out. I don't really have a like how much is too much. I see 1 to 2 years of IO as being in alignment with heavy value add business models, right? It gives you 2 years to go in, put a lot of capital in, reposition the property, get good tenants. But by year 2 or 3, you should kind of be at a stabilized point. And if you can't bear the debt burden of non-IO debt, then you might be getting in over your head. So as long as there's alignment there with the business plan, I think it's fine. 5 years on a stabilized business plan, it's not for me. That risk reward profile doesn't match kind of what I want to go into, but it might be right for you. Any thoughts on evaluating investments in towns that are geographically far? Do you just go by operators' documents, or do you do something over and above? Yep, I think there are some pretty easy ways to verify like rent comps in the area. I wouldn't necessarily use the rent comps that the operator puts in front of you in the OM, but going on apartments.com and again, looking at the type of property, right? What are the physical characteristics and amenities of the property that were talked about earlier in the presentation? That can tell you a lot, that can let you know if you're comparing apples to apples, right? So if your operator is saying, hey, we can get $1,000 a month in rent, but all the comps that you pull up on apartments.com are 9-foot ceilings, they have pools, they're B class or above, they look really nice from the outside, and yours is some 1960s build cinder block little turd that's been painted turquoise. That may not be the right comp. So you could definitely do a lot from far. Just comparing rent comps and looking on city data type sites to look at your submarket for crime and other things to really make sure that you're not being sold too much on the potential of that particular area. Siva says he's seen a GP who's raising money for just closing costs and financing it 100% LTV. Is that a red flag? So raising money just for the closing costs, financing LTV. It's hard to know if that's a red flag without knowing the business plan. I think 100% LTV is, I would not be necessarily comfortable doing that. If they're raising just for closing costs, then that implies there's no CapEx budget, there's no replacement reserves, there's no things like that. So, if it's a heavy value add, a lot of times a 70% loan to cost loan might be the same as 100% loan to value or loan to purchase price. So if this is a heavy value add and he's also raising money to do the renovations, and when it's all said and done, you think the value of the property will have increased by 30, 40, 50%, then what going in is 100% LTV loan might end up being a 70% LTV loan in a year or two. I won't say it's definitely a veto, but it is a little suspect. I haven't seen 100% LTV again, unless it's also 70% loan to cost. Mark asks, do you underwrite a refi into your deals or just a 5-year hold and see if the deal works that way? If you underwrite for a refi post-stabilization, how are you projecting rates? Yes, so I do tend to underwrite refis years 4 to 5, but that's because I do a lot of value add of kind of C-class stuff that I'm trying to bring up to B class. So I'm putting a lot of money in, a lot of effort up front, not a lot of cash flow in years 1 or 2. Hopefully it's stabilized by year 3. And then I want to give myself a 2-year window to let it season and to not be forced into selling because, oh my gosh, I've got 6 months till my loan term is up and the bottom has fallen out of the market, COVID style, right? So that is my timing. But again, that financing has to match up with the business plan. If I bought a stabilized B class, I'm just going to let it run for the most part. And, as things turn, I'm going to repaint and maybe switch out appliances. Then maybe my financing can be longer term, 7 to 10 year term. As far as projecting rates on refi, kind of like the cap rate, if it's in, if it's that year 3 to 5 range, whatever the interest rate that I can get today, I'll increase it by 50 basis points, half a point. And that'll kind of be my assumption. So it leaves a little bit of room for rates to rise, which is 2 to 3 years is kind of the short term. Every indication from the Fed is that they are committed to keeping rates low for several years. But I'm not going to, count on their word for that. So I'm going to build in a little buffer there. But I could definitely see a pretty low interest rate environment for a long time. Yan asks about another question regarding the refi. Do you see most of the GPs treat refi as return of capital or return on capital? Yes. So it is, I have only ever seen it be a return of capital. And there are advantages to that. There are disadvantages to that. When it's a return of capital, it's a tax-free distribution back to you because it's not a gain of any sort. It's just the partnership saying, you gave me $100,000. I'm going to give you, of that $100,000, I'm going to give you $80,000 back. So the government says, okay, you just got your money back. That's not a gain. That's non-taxable. So that's the benefit. The downside is your capital account balance will have been reduced from $100,000 down to $20,000. So your distributions now will be reduced, right? If you had an 8 pref on that deal, now that's going to be 8% of 20K is the calculation versus 8% of 100K. So you've gotten money back, but your cash flow will be reduced a little bit, commensurate with your reduction in the capital account balance. Meaning whether the cash flows afterwards are based on shrunk capital base or the original investment. Yeah, it would be shrunk. It's called the capital account balance, and that would have been reduced. But I think that is the preferred way to do it because if I, like on the value add I'm doing now in Greensboro, it's a 50 unit. And by year 3, we'll be in a position, again, if all goes well, to refi and basically get 100% of the capital pulled out. So if you were to say to me, you can, I'll give you all your money back in 3 years, and then indefinitely you're going to get 70%, or you, the investors, are going to get 70% of the cash flow from this property, and we can hold it indefinitely with zero money in. That's pretty compelling. May not be for everybody, right? But that's a compelling investment profile. And if it matches with your personal goals, then that's something that you would probably want to participate in. That's kind of the, that's like the, I'm drawing a blank, but it's what everybody strives to provide. If you can return 70% plus of the capital, at that refinance event, that usually justifies the cost of that transaction to give the capital back to the investors. So we as operators like to do that, let you now have access to your funds again. You can go do something else with those funds and earn a return on that, while you're also still getting a return on the property itself. So it's a pretty standard maneuver. It's not something I look at as nefarious or a tool that is used to juice returns in any way. It has a meaningful benefit to investors, and it's a valuable tool. Great. That is, I think we're up on our time. I appreciate everybody for sticking with me this long. I know some of this was pretty dense. We don't expect you to memorize everything, but as you were looking at OMs from your sponsors, I hope that from this point on, you can kind of look at it with a more critical eye, and maybe some of the things that I talk about will serve as kind of a framework for you to really judge, without looking at the IRR itself, to judge whether the investment is right for you.
Actually, Ryan, I have a question. So it was a really great overview of basically like looking at the whole business plan and property characteristics, etc., and sort of like looking for inconsistencies in that is to assess like the whole thing, right? Rather than look at the flat IRR number. But I was curious, what is your view on purely from a sort of mathematical perspective? What are some deficiencies of IRR? And I can communicate just my own kind of input as for assessing my own project. So for me, like I tend to think of in that scenario, I tend to think of IRR as okay, we have a cap rate. Okay, that's the property sort of NOI, right, on divided by its by the price. Okay, so that's the property profitability. But then if you have cash on cash, so now that's reflective of financing, right? It's reflective of leverage. It's reflective of the cost of that financing as well. And then if we have an IRR calculation, now that's cash on cash, sort of, but also reflective to me, like purely like very intuitively in my own calculations, like I would tend to, okay, I want to like get an IRR calc, so to say, if I want to get, okay, I have the cash on cash, but I want to get also the value add baked into a number, right? Okay. Now that's not desirable. That reduces your stuff, right? So basically, so that's what I'm trying to say. So let's say cap rate, property profitability, cash on cash, property profitability with the financing baked in, and then IRR, cash on cash with the value add baked in. But also there is a time component. So now in IRR we have the 5 time points, right? We have time or whatever time 0, and then like up to time year 5, let's say year 1, year 2, year 5. And then for me, like purely IRR is just a very difficult metric from that perspective to how to say to, if I have a project where there are very big outlays at the beginning of that project, IRR becomes really wacky, right? Like just purely separately from all the tweaks and all the things that that you really well like elaborated on. For me, it's very sensitive to, okay, now it's reflective of time component, whether, for example, a refinance happens at year 1, or whether there's a big cash outlay at the sixth month of the project, let's say, and things like that. But is this really important to me? Sometimes I can be completely indifferent, right? So then I have a 20% IRR on a 10% IRR versus a 20% IRR, or maybe it's going to jump to a 40% IRR or something, right? In a like on a really small project, and it's literally double the IRR number, and yet I am completely indifferent whether that happens at the 6th month or the half time point or the 1 time point, right? So that's like sort of the like just like something to say. So I was curious, like, what is your opinion on that, and like if you have like an insight as for how IRR can be manipulated from a purely other than like massaging all the assumptions and the exit cap and all that stuff, but just from a purely how to say like it's just for me and not a super intuitive number. You understand? Like it's for me, it's a strange number, right? It's like too complicated to understand. If you think about the fact that it reflects the time points, it's already not something I think that a human can really understand well.
That's it is an attempt to have one number that represents that you can use to compare across lots of different asset classes, right? It's the one to rule them all, right? The one return number to rule them all. So it's complicated, and I think it's useful, but it is flawed to think that there is any one number that can ever wholly represent a projected return, because there's so much that goes into the return. Like you mentioned, you have different cash out events at different times. You've got, equity multiples. You got the time frame that you're holding it, and that there's it tells you very little about the return itself. And you can have two investors that are looking at a 15% IRR or 10% IRR, and depending on their priorities and the return profile of that particular investment, it'll be right for one of those investors and completely wrong for the other, right? So it's just, you can't ever use one number. So I think it's really important to think about for yourself, why am I investing in this asset class? Real estate has some very distinct advantages over others. We all know about cash flow. We all know about the tax advantages. It can be pretty balanced, where you get cash flow, you also get appreciation, but also has some downsides as far as illiquidity, long hold times, and whatnot. So, you see IRR, cash on cash, refinance events, return of capital events. Those are all things that that could be different even when the IRR stays the same. So it's really about individual preferences. I don't know enough about the mathematics of how IRR is calculated to know if it is fundamentally flawed in some way, but I know that it is an attempt to take in the time value of money, and to be able to, even if there's a return of capital event that returns all 100% of your capital, it's still a way to measure that return, right? So it's trying to do a lot of heavy lifting for the goal of being like one number that is truly comparable across asset classes, which it's a pretty lofty goal, and you can expect to be a little coarse grained at times when you're trying to do that.
Yep. Yeah, I agree. And yeah, you mentioned the individual preferences part as well. So I think that's quite different. You can't have a return assigned to that. So, okay. Yeah, if anyone has some more questions, feel free to go. I'm not sure if we can get like a couple of more minutes, and we're over time, but.
Yeah, it looks like I think we got all the questions in the chat. So I feel like I'm good on my side.
Okay.
I just want to add one thing.
Yes.
It's related to your comment on the IRR. So basically, IRR is just like a common metrics to compare across different projects, because at the end of the day, what you are doing is that you discount future cash flow to today, right? So each project or different asset class, they have different cash flow in the future. So how do you compare them? So how do you compare them? You need to discount them back. So the IRR is the discounting factor so that you can compare to them. So, but the issue with that is, as you said, a lot of people just manipulate that number. So you can't just compare to that. Another thing I want to add is that when you look at two projects with two different IRR, not just jump to the one with higher IRR, you also need to consider what kind of risk I'm taking. So you really want to compare is risk-adjusted return. So if one is cash flow property give you 10%, another one, let's say, it's highly value add project, but it only gives you 12%. Are you willing to take additional risk to just get that 2%, right? So each person has different like a preference. So yeah, that's what I want to add. I really like your content. It's really good. Thank you.
Oh, thank you very much. And I completely agree with your comments as well. That's one thing I didn't explicitly talk about, but it was kind of woven throughout this discussion was, the risk return profile. It's a pair that cannot be unlinked, right? So IRR is a measure of upside, but it does nothing to talk about your downside. And I mentioned a couple things in here around financing and different aspects of the business model that kind of define your floor. I have investors that would be happy with a 6% first lien return, right? So very, very limited downside, and all they're getting is 6%. It's fine if you want that return, right? Real estate is a very flexible asset class, and there are ways you can get that return with real estate. But then there are also, I think a lot of newer investors, again, they're trained to look at the IRR. Syndicators are ones that are marketing the IRR and putting in all the material and really talking about that as like the judge of the value of their property. And so we just get kind of sidetracked, and there's not a lot of nuance to how we talk about investments of all asset classes, not just multifamily. So I really want to make sure that as an investment group, we don't fall into that trap. Had another question here from Sanjay. Understanding the need to look beyond other things other than IRR prior to closing. When you haven't narrowed down a property or deal yet, and you're doing initial screening for many choices, do you still find IRR valuable as a screening tool? If not, are there metrics you would find as a screening tool? So I had this slide, but had to kind of skip over it due to time. Let me go back here. I kind of labeled it extra credit. So these are numbers, like numerical values that I will use as like first pass. Hey, how much value is there in this particular deal? So they're numbers, they're metrics, but they're based on entry numbers, right? Numbers that are known on day one, not projections from year 5, right? Or stabilized projections from year 2 or 3. So, they can be things like your cost of debt, the spread between your cost of debt, your interest rate, and the cap rate, right? I want to see at least 150 basis point spread there between your interest rate and your cap rate. That's the minimum for me. I've seen deals where, they're a little bit less. And again, everything shows a 14, 15% IRR, but I like to see a little bit of a spread there. There's some really good, being an operator that's kind of focused on just a few markets here in Central North Carolina. If I get an offer, an OM from a broker, and it's for a C-class property that's built in 1972 in an area that I know pretty well, and the rent rolls are pretty, they got $600 rents. I'm like, okay, I know that property is going to take a lot of work. I know that I have to put a lot of investment in my own capital into the deal, or raise capital to put into the deal to turn that reposition around. So it's basically a heavy value add plan. And I know that at those rents and what the upside for that particular market is, if the listing price is, $75,000 a door, I know that's not going to work in my market. Every market's going to have way different price per door kind of baselines for you. And it's so dependent on many factors. But if you're kind of focusing on one specific type of asset in areas, you can start to pretty quickly get a sense of, oh, when I see something from a broker that's 100K a door, that's a good value, or it's not a good value, and vice versa. Also, your day one debt service coverage ratio, right? So if you take your new debt and whatever the debt service payments are, and you take your NOI, your day one NOI, basically what the property is operating at today, what the NOI is today, divide that by your debt service. If it's 1.3, 1.4 or above, that means even if you didn't improve the property at all, which is what's going to be the reality on day one, there's enough delta between what the property is earning you today and what your new debt is going to cost that you're okay, right? You've got about 30% of buffer there, which is enough to provide you with a lot of downside protection. And again, that's something that on day one of ownership or day -1 of ownership, right? So it's a knowable number. It's not a projection. A few other ratios here, and some sensitivity analysis is a thing that I like to look at. Again, day one NOI. What does the economic vacancy or the total vacancy have to be for my NOI to reach zero? And including debt service. So it's NOI plus debt service, right? So it on day one, how much reduction in performance of the property can I tolerate before I can't even, I can't pay myself and nobody's getting any money. So those are some metrics that I will use. Again, they're first pass. They don't tell you a lot about the potential of the property in the future. But again, that's the whole point of this, is to not rely on projections of the future for this first pass. It's like, what is on day one, is this property sustainable on its own? And then what I can do as far as capturing the upside is potential that I'm capitalizing on and me and my investors are capitalizing on. But I want to know that my starting point is a solid starting point. And then it's up to my ability to execute to capture that upside. So those are some of the metrics that I use.
All right, great. Thanks, Ryan. So actually, we had a question if we can share your email address so the people can reach to you, or other way, like on LinkedIn, etc. And
yes. So I'm dropping my email address into the chat. It's just Ryan at this domain, Flywheel EQ, down here. I'm also on LinkedIn. I'm on Twitter as well. Feel free to message me there, email me directly, sign up for the mailing list on flywheeleq.com. I have a monthly newsletter. I kind of talk about the performance of the current portfolio, struggles. I try to be very transparent, very open. So if things are not going well or we're hitting a snag in some area, I talk about that just as much as I talk about the successes that we're having. So would love to hear from you. If I also mentioned 2 articles. So if you go to my site, Flywheel EQ, up here, there's a newsroom link. I've got some articles. So I mentioned this one. The first one up here is about yield maintenance and prepayment options. It's pretty in depth. I would not recommend this late night reading. When you're fresh and you got that first cup of coffee, you could definitely do that. And then also one of the first articles I had was about cap rates. So it's really discusses, you may know how to calculate the cap rate, but it discusses all the different uses of the cap rate. Cap rate does a lot of heavy lifting in this industry, and people throw it around like it's just a easy to understand and a very deterministic number, but there's so much variability in how it's used, what it means in different contexts, that I wanted kind of one place that we could talk about what the cap rate means and how to think about it. So I try to do that in this article as well. So that's, cap rates are super important when you're looking at offering memorandums and dissecting what assumptions are. So make sure you do that as well.
All right, thanks. And so the lecture was really super informative, I would say. Is it possible to share the slides?
Absolutely. How would you like me to do that, Stefan? If I email you just a PDF download of the slides, is that appropriate?
Yeah, that should be good. Yeah, and I can get it to whoever else wants to have it, or if you feel like emailing Ryan directly, that should work as well.
Yep, absolutely.
Okay. Yeah, thank you so much. So thanks for everyone for staying with us and staying a bit over time as well. It was a great lecture, and thank you so much. Really appreciate it.
Thanks for having me, Stefan. Thank you, everybody, for the really good questions. I enjoyed the opportunity to speak to you all.
Thank you as well.